What would you do if overnight your bank told you that your own money wasn't fully yours anymore? That quiet assumption of access, the idea that you can withdraw cash whenever you need it, can vanish faster than most people are prepared to believe. Moments like these don't come with polite warnings, they arrive in waves of confusion, long lines, and sudden rules. This is exactly the kind of scenario seasoned investors think about long before it happens, not out of fear, but out of respect for how fragile financial systems can become under pressure and how quickly hesitation can turn into regret. The mistake most people make in moments like this is assuming there will be time. Time to think, time to watch the news, time to wait for clarity. But when financial systems begin to tighten, they rarely do so gradually in a way that benefits the average person. Restrictions don't feel real until they are suddenly enforced, and by then, the window for easy action has already narrowed. The idea that you can simply log in tomorrow and move your money is a comforting illusion, one that has failed people repeatedly in past crises. What matters in these situations is not intelligence or even experience, but speed of recognition. The ability to understand what's happening before it's officially acknowledged is what separates those who maintain control from those who are forced to react. When banks begin to limit withdrawals, whether subtly through policy changes or more directly through caps and delays, it signals stress within the system, and stress, once visible, tends to accelerate rather than stabilize. Waiting for reassurance from the same institutions imposing restrictions is a losing strategy. There is also a psychological trap at play. People are conditioned to trust stability because most of the time, stability is all they've ever known. So when early warning signs appear, longer processing times, unusual notices, changes in withdrawal policies, they are often dismissed as temporary inconveniences. This denial isn't irrational, it's human. But financial pressure doesn't care about comfort. It compounds quietly and then expresses itself all at once. By the time the majority recognizes the shift, options had already become limited. Acting early doesn't mean acting recklessly. It means understanding that access is more valuable than yield in uncertain moments. A dollar you can't reach is not truly yours in any practical sense. This is where many people hesitate, especially those who have spent years optimizing returns, trusting systems, and building routines around convenience. The shift from maximizing growth to protecting access feels like a step backward, but in reality, it's a strategic pivot. Control becomes the priority. Another layer of complexity is social proof. If everyone around you appears calm, it becomes even harder to justify taking action. There's an invisible pressure to conform, to not overact, to avoid being the outlier. But financial disruptions don't reward consensus thinking. They reward independent judgment. By the time concern becomes widespread, the advantage of early movement is gone. Lines form, limits tighten, and decisions are no longer made on your terms. Technology can amplify both confidence and risk. Digital banking creates the illusion of instant control. Balances are visible, transfers seem effortless, and everything appears just a few clicks away. But behind that interface are systems that can be slowed, restricted, or paused entirely. When too many people try to act at once, friction appears where none existed before. What once felt seamless becomes congested, and that congestion can quickly turn into restriction. There's also the issue of official communication. Institutions rarely frame developing problems in a way that encourages urgency. Language becomes softer, more technical, often designed to prevent panic rather than prompt action. Phrases like temporary measures or precautionary steps can mask the seriousness of what's unfolding. Interpreting these signals correctly requires reading beyond the surface and recognizing intent as much as content. The real advantage lies in preparation meeting timing, not blind panic, not constant suspicion, but a readiness to act when conditions shift. This readiness isn't built in the moment, it's built beforehand through awareness and a willingness to accept uncomfortable possibilities. When restrictions begin to appear, even in mild forms, they are rarely isolated events. They are part of a broader pattern that tends to evolve quickly. Hesitation often comes from the fear of being wrong, Moving funds, adjusting positions, or taking precautionary steps can feel unnecessary if the situation stabilizes. But the cost of being slightly early is almost always lower than the cost of being late. In environments where access can change overnight, the margin for delay it doesn't reopen easily. And once that realization sets in, the entire framework most people use to think about money begins to shift. The metrics that once mattered, interest rates, returns, long-term growth, suddenly lose their urgency. In their place, something far more immediate takes priority: access. Not theoretical value, not projected gains, but the simple, practical ability to use your money when you decide to use it. This is where the concept of liquidity stops being an abstract financial term and becomes a very real dividing line between control and dependence. Liquidity is often underappreciated during stable times because stability hides its importance. When everything functions as expected, it's easy to believe that assets are interchangeable, that money in a high-yield account, a fixed deposit, or even certain investments is just as good as cash. But under pressure, those differences become stark. What seemed like a small trade-off for better returns can quickly turn into a significant barrier when speed is required. The inability to convert assets into usable funds immediately can create a chain reaction of limitations. There's a subtle but critical distinction between wealth and usable capital. On paper, someone might appear financially secure with funds spread across accounts, instruments, and institutions. But if those funds are not readily accessible, their utility diminishes at the exact moment it matters most. Liquidity is what transforms value into action. Without it, even substantial resources can feel out of reach, locked behind processes that no longer move at the pace you need. This is where conventional thinking begins to break down. For years, the focus has been on optimizing, finding better yields, leveraging opportunities, minimizing idle cash. And under normal conditions, that approach makes sense. Idle money is often seen as wasted potential. But in uncertain environments, idle money becomes optionality. It provides flexibility, speed, and independence. It allows you to respond rather than react, to move before constraints tighten further. The challenge is that prioritizing liquidity often feels counterintuitive. It can feel like stepping away from progress, like giving up gains for the sake of caution. There's a psychological cost to holding cash or near cash positions when markets are offering returns elsewhere. But this is where perspective matters. The goal is not to maximize returns in every environment, it's to adapt to the environment you're actually in. When signals of restriction appear, the environment has already changed, whether widely acknowledged or not. Another factor is the illusion of partial access. Some systems don't impose outright restrictions immediately, but instead introduce friction, limits on daily withdrawals, delays in transfers, additional verification steps. These measures can create a false sense of security, as access is not completely removed, just slowed. But in practice, slowed access can be just as limiting as restricted access when urgency is involved. The difference between immediate availability can define outcomes in ways that are not obvious until tested. Liquidity also carries a strategic advantage beyond immediate access. It creates leverage in uncertain situations. When others are constrained, those with accessible capital have options. They can position, secure necessities, or take advantage of opportunities that arise from dislocation. This doesn't mean acting aggressively, it means having the ability to choose. And choice, in constrained environments, becomes one of the most valuable assets of all. There's also an emotional dimension to liquidity that is often overlooked. Financial stress is amplified when access is uncertain. Even individuals with significant assets can feel pressure when those assets are not easily reachable. Liquidity reduces that pressure. It restores a sense of control, allowing decisions to be made with clarity rather than urgency. This clarity can prevent mistakes that are often made under stress when time and options feel limited. Institutions, by design, prioritize stability over individual flexibility. Their systems are built to manage large-scale behavior, not to accommodate sudden, widespread demand for access. When stress emerges, their response is to slow things down, to manage outflows, to maintain order. From their perspective, this is rational. From an individual's perspective, it introduces constraints. Understanding this difference is key to recognizing why liquidity matters more in these moments than it does during periods of calm. What complicates this further is the gradual nature of realization. People don't immediately shift from a return-focused mindset to liquidity-focused one. The transition often happens unevenly, with hesitation and second-guessing. Early movers may feel uncertain, questioning whether they are overreacting. But as conditions evolve and access becomes more visibly constrained, that uncertainty tends to fade, replaced by a clearer understanding of what actually matters when systems are under pressure. That clearer understanding naturally leads to a more uncomfortable question: where exactly is your money, and how dependent are you on a single point of access? Most people don't think in these terms because the system is designed to feel unified and seamless. One bank, one app, one primary account. It's efficient, familiar, and easy to manage, but concentration, while convenient, quietly increases vulnerability. When access depends on a single institution, any restriction imposed there becomes absolute for you. Diversification is usually discussed in the context of investments, spreading risk across stocks, sectors, or asset classes. But in moments of financial strain, diversification of access becomes just as important, if not more. It's not about chasing returns anymore. It's about ensuring that no single decision made by one institution can completely dictate your ability to act. This shift in thinking is subtle but powerful. It reframes diversification from a growth strategy into a resilience strategy. The risk with keeping everything in one place isn't just about outright failure. It's about policy changes, operational slowdowns, or precautionary measures that may be entirely rational from the institution's perspective, but restrictive from yours. Even well-managed banks can impose limits if they face broader systemic pressure. And when that happens, their priorities are not aligned with your need for immediate flexibility. They are managing liquidity at a macro level, which can come at the expense of individual access. Spreading funds across multiple institutions introduces a layer of independence. If one channel becomes constrained, others may still function normally, or at least differently enough to provide options. This doesn't eliminate risk, but it prevents it from becoming singular and overwhelming. Instead of facing a complete barrier, you're navigating partial friction, which is a fundamentally different position. Partial access still allows movement, still creates room for decisions. There's also a timing advantage embedded in diversification. Restrictions are rarely implemented uniformly across all institutions at the exact same moment. Some react earlier, others later, depending on their exposure management strategies and external pressures. This staggered response creates windows, brief, often unpredictable opportunities where access remains open in some places while tightening in others. Being diversified means you are more likely to still have a functioning channel when others are already experiencing constraints. Another overlooked aspect is the difference in systems and processes between institutions. Even in a connected financial world, banks operate with varying technologies, policies, and thresholds. What triggers a delay or restriction in one place may not apply in another, at least not immediately. This variation becomes an advantage when speed matters. It introduces asymmetry into a situation that might otherwise feel uniformly restrictive. There's a psychological benefit as well. When all your funds are concentrated, any sign of restriction creates immediate pressure. Every decision feels urgent because there's no backup. Diversification reduces that intensity. It allows for more measured responses because access is not entirely dependent on a single outcome. This doesn't remove uncertainty, but it makes it more manageable. It shifts the experience from panic to problem solving. However, diversification requires intention. It's not something can be fully implemented in the middle of a tightening environment without friction. Opening new accounts, transferring funds, establishing access, all of these processes can slow down precisely when you need them to be fast. This is why the concept is most effective when considered before it becomes urgent. Once restrictions begin, the ease of movement that existed before starts to erode. There's also the question of overconfidence in perceived safety. Many people assume that larger or more established institutions are immune to restrictions. While they may be more resilient in certain ways, they are also more deeply integrated into the broader system. This integration can make them more responsive to systemic pressures, not less. In some cases, their actions can even set the tone for others, meaning that restrictions implemented there can ripple outward quickly. Diversification doesn't require complexity, but it does require awareness. It's about recognizing that access is not guaranteed equally across all channels at all times. It's about building optionality into your financial structure so that when conditions shift, you're not relying on a single pathway to respond. The goal isn't to predict exactly which institution will face constraints, but to ensure that your ability to act isn't entirely dependent on getting that prediction right. And once you begin to see access as something that can vary from one institution to another, a more selective mindset starts to take shape. Not all banks carry the same level of resilience under pressure, and more importantly, not all of them respond to stress in the same way. Some tighten quickly, others try to maintain normalcy for as long as possible, and a few may already be operating closer to the edge than they appear. The surface often looks calm right up until it doesn't. The difficulty is that weak financial institutions rarely presents itself in obvious ways to the average person. It's not like a visible crack that signals immediate danger. Instead, it shows up in subtler forms, changes in internal policies, shifts in lending behavior, adjustments in withdrawal processes, or even the tone of communication. These signals can be easy to overlook, especially if you're not actively paying attention, but they tend to cluster before larger actions are taken. Reducing exposure isn't about panic or trying to predict collapse with certainty. It's about recognizing that strength is relative and that some institutions are better positioned to handle stress than others. When early signs begin to appear, the goal is not to wait for confirmation, but to reassess where your money is sitting and how much confidence you actually have in each place. This is less about abandoning institutions entirely and more about rebalancing your dependence on them. There's a natural hesitation here, especially when dealing with familiar banks. Trust builds over time, and moving funds away can feel like an overreaction or even a betrayal of that trust. But financial systems are not built on personal relationships. They are built on balance sheets, liquidity ratios, and exposure to risk. When those underlying factors shift, the outward experience can change quickly, regardless of how stable things felt before. Another layer to consider is how quickly sentiment can move once doubt enters the system. Banks operate on confidence as much as capital. As long as people believe in their stability, the system functions smoothly. But when that belief starts to weaken, even slightly, behavior changes. Withdrawals increase, scrutiny intensifies, and institutions begin to protect themselves more aggressively. This shift can happen faster than most expect, turning what seemed like isolated concerns into broader pressure. In that environment, holding significant exposure to a single institution, especially one showing early signs of strain, becomes a calculated risk. The longer you remain fully committed, the more you are relying on an outcome you don't control. Reducing exposure doesn't mean exiting completely. It means adjusting your position so that if conditions worsen, your ability to respond isn't compromised. It's a way of buying flexibility without needing perfect foresight. There's also a sequencing advantage to acting early. When fewer people are moving funds, processes tend to remain smoother. Transfers go through faster, systems are less congested, and scrutiny is lower. As pressure builds and more individuals attempt to do the same thing, friction increases. What once took hours can take days, and what once felt routine can start to feel uncertain. Early movement isn't just about avoiding restrictions. It's about avoiding the bottlenecks that come with collective reaction. Information asymmetry plays a role as well. Institutions have a clearer view of their internal conditions than the public does. Their decisions are often made based on data that isn't immediately visible externally. By the time those decisions manifest as policy changes, the underlying issues have already been developing. This lag between internal awareness and external impact creates a gap, one that individuals can either ignore or try to navigate. Reducing exposure is essentially about respecting that gap. It's an acknowledgement that you don't need complete information to make a prudent adjustment. Waiting for full clarity often is waiting until the situation has already evolved beyond the point of easy action. Acting on partial signals, when combined with an understanding of how these situations typically unfold, can provide a meaningful advantage. There's a balance to strike between overreacting and underreacting, and that balance is rarely obvious in real time. But leaning slightly toward caution in uncertain environments tends to preserve options. The cost of shifting some funds, adjusting allocations, or spreading risk is usually manageable. The cost of staying fully exposed to a weakening position can escalate quickly if conditions deteriorate. What makes this particularly challenging is that stability, when it returns, often makes precautionary actions seem unnecessary in hindsight. This can reinforce complacency, making it harder to act decisively in the future. But each situation carries its own dynamics, and relying on past outcomes to justify inaction can be misleading. The focus isn't on being right every time, it's on maintaining the ability to respond effectively when it matters most. Maintaining that ability to respond effectively leads to an even more unconventional layer of thinking, one that many people are reluctant to consider until circumstances force it into focus. What happens if access isn't just slowed or limited, but structurally constrained within the system itself? At that point, the question is no longer about which bank or how many institutions you're using, but whether all of them are subject to the same overarching controls. When the framework tightens at a higher level, diversification within it can only go so far. This is where the idea of holding a portion of assets outside the traditional banking system begins to take on practical significance, not as a dramatic rejection of the system, but as a recognition of its boundaries. Banks operate within regulatory structures, and in times of stress, those structures can impose rules that apply broadly, sometimes universally. If those rules restrict movement, then having all your resources contained within the environment limits your flexibility in ways that no amount of internal diversification can fully offset. The concept itself can feel extreme at first because it challenges deeply ingrained habits. Most people are accustomed to thinking of banks as the default place for money, secure, regulated, and accessible. Moving even a small portion outside of that framework can feel like stepping into uncertainty. But in reality, it's a shift from centralized dependence to distributed control. It's not about abandoning safety. It's about redefining what safety means under different conditions. Control, in this context, becomes more tangible. Assets held outside the system are not subject to the same immediate restrictions that can be imposed within it. They don't rely on approval processes, operational hours, or digital interfaces that can be slowed or paused. This doesn't make them immune to all forms of risk, but it does change the nature of that risk. Instead of institutional constraints, you're dealing with factors that are more directly within your awareness and influence. There's also a timing dimension that becomes critical. When restrictions are announced or even hinted at, the movement of funds within the system often accelerates rapidly. But moving assets out of the system entirely can become more difficult as scrutiny increases. Processes that were once simple may require additional verification, face delays, or be temporarily suspended. This creates a narrowing window where such transitions are easier to execute. Waiting until urgency is obvious often means operating within tighter constraints. Another factor is perception. Actions that seem unnecessary during stable periods can appear obvious in hindsight once conditions change. Holding some assets outside the system may feel overly cautious when everything is functioning smoothly, but that perception shifts quickly when access becomes uncertain. What once looked like an outlier decision starts to resemble foresight. The difference lies in timing, not in the logic itself. There's a practical side to this as well. It's not about moving everything or making drastic, irreversible changes. It's about creating a buffer, a portion of resources that exists independently of systemic controls. This buffer doesn't need to be large to be effective. Its value comes from what it represents: immediate access, autonomy, and the ability to act without waiting for external permission. In constrained environments, even a modest level of independent access can make a significant difference. Psychologically, this shift can be grounding. Knowing that not all of your resources are subject to the same set of rules reduces the sense of vulnerability that can arise when systems tighten. It introduces a form of balance where uncertainty in one area is offset by stability in another. This doesn't eliminate concern, but it changes how that concern is experienced. Instead of feeling trapped within a single framework, there's a sense of having alternatives. Of course, this approach requires a different kind of responsibility. Assets held outside traditional systems don't come with the same safeguards or conveniences. They require awareness, planning, and a clear understanding of how they are managed. But in exchange, they offer a level of independence that becomes increasingly valuable when centralized systems face pressure. The broader theme here is adaptability. Financial environments are not static, and strategies that work well under one set of conditions may need to evolve under another. Holding a portion of assets outside the banking system is one expression of that adaptability. It acknowledges that no single structure, no matter how reliable it has been, is beyond stress or limitation, and by stepping partially outside of it, you create space to operate even when the system itself becomes more restrictive. That space to operate, however, only has value if you're willing to use it when the moment demands. Having options is one thing, acting on them is another. This is where the final and often most difficult shift takes place, the transition from awareness to decisive action. Because even with preparation, diversification, and independent access, hesitation can still erode advantage. The window between recognizing a developing situation and acting on it is often narrower than it appears. Decisiveness in these moments isn't about speed alone, it's about clarity under pressure. When conditions begin to change, information is rarely complete or perfectly reliable. Signals can be mixed, opinions divided, and outcomes uncertain. Waiting for perfect confirmation feels logical, but in practice, it delays action until the situation has already evolved. The ability to move with information, guided by patterns rather than certainty, becomes a defining edge. There's a natural resistance to this kind of action. Moving too early carries the risk of being wrong, of disrupting your own system unnecessarily, of stepping outside the comfort of routine. But what often goes unrecognized is that inaction is also a decision, one that carries its own risks. Choosing to wait is effectively a bet that conditions will stabilize, that access will remain intact, and that time will remain available. When that bet fails, the consequences are no longer theoretical. Momentum plays a powerful role in these scenarios. Once restrictions begin to tighten, they tend to reinforce themselves. More people attempt to withdraw or reposition, which increases pressure on institutions, which in turn leads to further restrictions. This feedback loop can accelerate quickly, turning what seemed like a manageable situation into a constrained environment in a very short span of time. Acting before that momentum builds is fundamentally different from trying to act within it. There's also a difference between reacting and preempting. Reaction is driven by visible change, lines forming, limits announced, delays experienced. Preemption is driven by interpretation, recognizing early signals, and before those signals become obvious to everyone else. The earlier you operate on that spectrum, the more control you retain over how and when you move. Once you're fully in reaction mode, your decisions are shaped by constraints rather than choice. Another challenge is the noise surrounds these moments. Information flows rapidly, often conflicting, sometimes exaggerated, occasionally misleading. This noise can create paralysis, as each new piece of input seems to challenge the last. Decisive action requires filtering that noise, focusing not on every detail, but on the broader pattern that's emerging. It's less about predicting the exact outcome and more about recognizing the direction of change. Execution itself becomes a critical factor. It's one thing to decide to act, it's another to follow through efficiently. Delays in execution, whether due to second-guessing, logistical friction, or overcomplication, can reduce the effectiveness of even the right decision. Simplicity often becomes an advantage here. Clear steps, predefined options, and a move without unnecessary refinement can preserve speed when it matters most. There's an emotional component that can't be ignored. Acting decisively in uncertain conditions often feels uncomfortable. It can create doubt, especially if others around you are not taking similar steps. This divergence from the crowd is rarely easy, but it's often necessary. Financial systems under stress don't reward collective hesitation, they expose it. The willingness to act independently, even when it feels premature, is part of maintaining control. Timing, again, is central. Acting too late compresses your options, while acting early expands them. The difference is not always measured in days or weeks, sometimes it's hours. As systems become more constrained, even small delays can have outsized effects. Access that was available earlier in the day may not be available later. Conditions can shift within a single cycle of activity, making responsiveness a key advantage. What ties all of this together is the recognition that control is not a static state. It's something that can be gained, maintained, or lost depending on how and when you act. Preparation creates the potential for control, but decisiveness is what converts that potential into reality. Without action, even the best positioning can become irrelevant as conditions change around it.